just quickly have to remind everybody now that we're recording that I am not an expert in this area, and this webinar is for general information purposes only. Always refer your clients to an accountant or a lawyer. So here we go. So the first thing we're going to talk about is opportunity cost. Opportunity cost is the perceived or real benefit of investing in one business, property, or a venture as compared to another. And opportunity cost is a really important concept to get your head around. Why does somebody do something in an investment? Some people think something's really risky, other people don't think so. And as an example, somebody might invest $5 million in a risky business venture, or invest $5 million in a GIC that pays 4 or 5%. Let's say that risky business venture pays 10%, okay? Or invest in a GIC that pays 5%. That opportunity cost is 5%, and people are willing to take those chances. And in the mindset of an investor, what's the better investment? Is it I want a guaranteed investment, or am I willing to take a risk? And the reason why opportunity cost is important is because when you're looking at capitalization rates, it will give the opportunity to compare risks between different investments. And those are called opportunity costs. What is the difference? It's the opportunity cost of doing one thing as opposed to another. So a capitalization rate. And here's where a lot of investors will think they know what they're talking about, and it's always funny to hear. Other people know what this is. A capitalization rate is a measure of risk, okay? It does not represent a guaranteed income, okay? Definitely not. I love it when a salesperson calls me and says they have a client and they want a capitalization rate of at least 10%. And I go, so they want a return of 10%. Is that correct? And the answer is generally yes. They're looking for a return of 10%. But that is a measure of risk, right? And so would you invest in a business that promises you a 20% return? Or how about a 5% return? Which is more realistic? Like, which is the more realistic return that you are probably going to get? A venture business like the previous slide, mining, you're going to invest in, well, we all should have invested in nickel stocks by the looks of things. How about copper stocks? If you invest in a copper stock, you're going to get a 20% return. Well, hopefully you guys don't believe that. There was an example a few years ago of an agent who wanted to invest in a cannabis business, and that marijuana business was promising a return of 30%. Is that realistic? No, it is not. If somebody says to you that you're going to get a return of 30% or 20%, you are going to have a high risk level that you may lose everything, or certainly not get to that level of 20 or 30%. A capitalization rate is a measure of risk. If you invest in something on the other side of the coin, if you invest in a guaranteed investment certificate, a GIC, that today a 5-year GIC probably can get you 3%, well, there's no risk, right, at 3%, right? And so back to opportunity cost. If you have a buyer that wants to invest in a business that has a capitalization rate of 3%, what is that buyer going to do? I know what I would do. Why would I work at something? And the potential is very low that it would fail, but I could get a guaranteed investment certificate for 3%. May as well do the guaranteed investment certificate for 3%, right? No risk. And as an example of risk, the capitalization rate is 3%. well, there better be zero risk in that business that somebody's investing in, because I have an opportunity cost that is equal with zero risk. Does anybody have any questions about this? This is where people get confused between the capitalization rate and the return on investment. And we're going to look at return on investment as we go down through the slides. But people believe that a capitalization rate is a return on investment. And to some degree it is, but it is telling you the measure of risk. A capitalization rate of 10 or 12% is way riskier than a capitalization rate of 3 or 4%. So does anybody have any questions about this? It's really important that you understand that a capitalization rate is a measure of risk. Any questions?
Yes, John, I have a question.
Sure.
I just want to make sure I understand correctly. For example, business does have a, for example, 5% capitalization rate. Does that mean that if we put $100,000 in that business at the end of the year, we are adding 5% to our capital, the money that we put?
Technically, the answer is yes. It says that you should get a 5% return on your investment.
But
Okay.
Before expenses. After that, we have to deduct all of the expenses during that year, right?
No, it's based on the net operating income, which we'll talk about in one moment. Okay. So a 5% return, that's pretty good. I mean, there's a chance, you have to also, it's a great question. You have to recognize that the buyer purchasing the business may look at, a 5% capitalization rate, but he can say to himself, well, if I do this, this, and this, and this, I should be able to get a higher return on investment, which is different from a capitalization rate. A capitalization rate is telling you the level of risk, okay? A return on investment is actually what's happening in the real world, okay? So it's like an indicator of what's happening, okay? Any other questions? Okay.
Yes. Hi, John.
Hi, Sarah. How are you?
Yeah. Good. I have a question on the capital rate, and does it can I think of like if the rate is higher, and like for example, the investor want to see the rate higher or the lower rate?
So that's a personal choice depending on opportunity cost. So some investors want to invest in, as an example, a Tim Hortons, and we'll talk about that in a moment. And that Tim Hortons has a very low capitalization rate because the return is probably going to be, 4%, as an example. Or is that investor going to invest in copper stocks, where the capitalization rate on a risky stock might be 12 or 15%. And so it's an individual choice for each buyer.
Okay.
There's no, there's and a lot of buyers, Sarah, to make it maybe a little clearer, there's a lot of buyers that have what's called diversified portfolios. And so they've got a GIC at 3%. They own a Tim Hortons franchise at 4%, but they also have some riskier things like a mining stock, right? And they've spread it around, right? They've got some mutual funds that pay 5%, that kind of thing, and they've diversified. So it's a personal choice.
Okay. Yeah. Okay. Thank you.
You're welcome. So what do you need to determine a capitalization rate? You need the net operating income. That is the key to figuring out a cap rate. You need to know, if you're working at trying to figure out what a cap rate is, you need to know how much is the property for sale for. And then of course you can do research, and different property types may have pre-established as a guideline different cap rates. And we're going to take a look at that as well. So this is what you need to determine a cap rate. So research for capitalization rates. You can go online. You can go to CBRE or Cushman and you can look up general capitalization rates. And they've got capitalization rates, in this case, a low-rise apartment A or a class A industrial, okay? So, and then they have a low-rise apartment B, they have a low-rise apartment C, they have class A industrial, they have class B industrial, they have class C industrial, and they give you some cap rates. You can look up mechanical shops, you can look up franchises, you can look up restaurants, you can look up, there's all sorts of different rates that you can look up from CBRE or Cushman Wakefield. And generally, you can get this kind of information that I'm showing on my screen. You can sign up to be a member of CBRE. It doesn't cost you anything to sign up. And that gets you a little more detailed cap rates than just this kind of a range of cap rates, okay? But this gives you a pretty good idea. So you have an investor, okay, that says, really interested in buying a low-rise apartment, okay? You can look up the different cap rates for low-rise apartments and the different quality of cap rates. So a low-rise apartment A at about 3.75%, a low-rise apartment B is going to have a higher cap rate. And the reason could be maybe there's higher turnover, there's more vacancies in the apartment, maybe the building has not been maintained as well as the A building, that kind of thing. A C, maybe it's in a poor neighborhood. Maybe there's people who are in the apartment because of the Tenancy Act are paying very low rent, that kind of a thing. Same as Class A industrial. Class A industrial, you know, a good building, relatively new, low maintenance, has great tenant in it, long-term tenants, that kind of thing. You can look this up for plazas. What is a Class A plaza? Well, a Class A plaza is a plaza that has been well maintained, has some really solid anchors, such as a bank or a McDonald's. Maybe it has a Freshco in the plaza, that kind of thing. You can look these up for your clients, and it's simple research. Capitalization rates, Google capitalization rates for low-rise apartments, Google capitalization rates for plazas. And you can, the capitalization research rates, you can narrow those down into cities, certainly by province. You can get them for all of Canada. They are all available for you at your fingertips to find capitalization rates. Now, what doesn't the research show you? The research will not show you the capitalization rate for a shoe repair shop, okay? Too small, okay? It's looking at the big picture stuff, all right? It's not looking at a mom and pop restaurant as an example. It does look at big franchises. You can find out those kind of capitalization rates, but not for small stuff. It's more of the bigger general things that you can find. So research is there for you to find capitalization rates for a whole host of different things. And if you don't go to CBRE or Cushman Wakefield, you can just simply Google, what is the average capitalization rate for a mechanical garage, you know, a repair shop for cars? And you'll get all sorts of different opinions on it, but usually they are pretty close to each other. And I happen to know this because I just did it a week or two ago. Capitalization rates for a mechanical garage are sitting at about 6.5%, 7.5%. You know, somewhere as high as 8, somewhere as lower than as 5.5, that kind of thing. And sorry, let me turn that off. And that'll give you a good indication of a smaller kind of business. So you can just search and see what people's opinions are on capitalization rates. And that'll certainly get you well within the ballpark of a cap rate. So how to calculate capitalization rates. I'll leave this on my screen. Take your phone, take a picture of this, okay? This is how it works, okay? So you find out what the net operating income is, which we talked a lot about in last week's session. And you find out that the net operating income is $100,000. And you can see here that happens is as the capitalization rate goes up, the value of the business goes down. It is inversely proportional because of risk. So $100,000 NOI, 10% cap rate, the value is $1 million. NOI, $100,000, the cap rate is 14%. Look what happens to the price. The business price goes down. NOI of $100,000, a 5% cap rate, look what happens to the value of the business. It goes up, okay? So to get back to Sarah's question on what should a buyer do, you can see now, Sarah, that, you know, sure, geez, what a deal, $100,000 NOI, but boy, it's a risky business at 14%. I may be willing to buy that because look, it's only worth $700,000. Okay, so people do that, Sarah, absolutely. Other people will go, oh no, if I'm going to take my money, I'm going to take it and spend $2 million because I'm guaranteed to get 5% back, almost guaranteed. And this is in a plaza, okay, where there's a good anchor, such as a TD Bank or a McDonald's, like I mentioned before, and I'm going to get a 5% return. All right, that is the inverse. The capitalization rate is inversely proportional to the value of the business. So it's great when somebody comes and says, like I mentioned before, oh, I want a 14% cap rate. I'm sorry, yeah, I want a 14% cap rate. And you go, okay, well, I've got a great deal for you. You know, it's only for sale for $700,000. So you've got 3 NOIs worth 100,000. And then which one are you going to do? It's up to the buyer's risk tolerance level. Sure, I had a great year. Just imagine, as an example, people had restaurant businesses 3 years ago, and the cap rate for the restaurant, $100,000 NOI is 10%. The value of their business is $1 million. What do you think the cap rate today is for a restaurant? Oh my goodness, it's going to be crazy. And if you look at 3 years ago, you're going to look at the value of $1 million. Well, guess what, Mr. Seller, you've just lost a lot of money over the last 2 years because your cap rate has not only has your NOI gone down, but your cap rate has gone up. Cap rates. So you have your net operating income and you have your value. So now you can see when you're looking at somebody who's asking for $1 million for their property and their NOI, now you can see clearly the measure of risk is 10%. Or the value that they've got it listed for is 714,000, and they're asking, and the NOI is 100,000. Now you know you're purchasing a more riskier business. And the last one in the middle column is the reverse again. You've got an NOI of 100,000, and they're asking 2 million. Well, gee whiz, your cap rate's 5%. It's telling you the risk involved by doing this. And now you can look at different risks. I'm sorry, you can look at different companies. You can see what their NOIs are. You can see what their cap rates are. You can see what the value is, and you can compare different businesses to other businesses, other ventures, and determine what risk value is happy for your buyer. And then the last one is you want to figure out the NOI. And this one is really helpful in the world today in the GTA. Somebody has $1 million listing, okay? You look up the cap rate for, I don't know, whatever, a mechanical shop, okay? And the mechanical shop says that the cap rate is 10%. And this is very, very useful if you have $1 million value and the cap rate is 10%, the NOI better be $100,000, okay? And then you ask for the statements from the seller, the listing agent, and the NOI is only 50,000. Well, gee whiz, they're asking too much money for this place. And that's when you see in the commercial side, you see properties or businesses for sale that have been on the market for 200 days and 250 days, 175 days. Well, guess what? The value is not equaling the NOI based on the capitalization rate. Just let me check the chats here, one moment. The question is the capitalization rate dependent on the market interest rate? No, it is not. It is a measure of risk. What is dependent on the market interest rate is your return on investment, which we will talk about in a moment, okay? And then somebody's asking, can you send me the slides after? No, I cannot. It'll be on the YouTube training channel. And so you can watch the whole thing, okay? Another question in the chat. In these three examples, if you were in the market, which one would you buy? So Jeff, once again, what is your risk tolerance? What is the buyer's risk tolerance? If as an example, Jeff, I only have $100,000 and that's all I've got, and my God, I don't want to lose it. Okay, I can't afford to lose that money. I want a low capitalization rate. I have to find something that I'm going to get a return on my money guaranteed. Maybe I should buy a GIC. Okay, but now I've got more money. I've got 100,000 here. I've got 100,000 there. I've got 200,000 here. I've got 400,000 there. Well, I'm willing to take a bit of a risk, and maybe I will buy something at a 10% capitalization rate. Okay, so I can't answer that question, Jeff. It is up to the individual buyer's risk tolerance. Okay, simple as that. Any other questions about these? This is the key. These are the mathematical formulas, and you can Google these. You can find these out easily yourself, but it is pretty handy if you take a picture of this. You're welcome, Jeff. So any other questions about these three ways? It's just simple math, right? It's just reversing and dividing and multiplying, right? And so it's not hard to figure these things out. Any other questions about this? Remember, folks, it's a measure of risk. So everyone wants to know the value of a business. Determine a cap rate, often by research, but also use some common sense in there as well. Like, the common sense thing that I want to talk about is back to the mechanical shop, okay, that they take cars in. So you look up, cars, mechanic shops are a cap rate of 10% just for fun. Okay, once again, as I said at the beginning, it's fictitious, these things. So the capitalization rate is 10%. You look up generally. And so now you're looking at an area, let's call it somewhere along Highway 11 let's change that. Highway 400 between Parry Sound and Sudbury. And I can tell you, because I used to live up there, there's long open stretches with nothing between Parry Sound and Sudbury, literally nothing, except halfway there's a mechanical shop, okay, where you can fix cars. And you've looked up that the capitalization rate for mechanic shops are 10%. So you've got this one place in the middle of nowhere, that's a mechanic shop, or you've got a mechanic shop at the corner of Yonge and Elgin Mills, right? Both basically have the same capitalization rate that you've looked up. But which is the better one to purchase, really, seriously? Obviously, the NOI is going to be much higher here in Richmond Hill than it is in the middle of nowhere, but it shows the same capitalization rate. So which one is the riskier investment? Well, gee whiz, The riskier investment is the one in the middle of nowhere, for sure. And as a result of that, their asking price should be lower and their capitalization rate should be higher, even though it's the same business. So some common sense is really, really necessary here, okay? You just can't just fly off the handle and say everything is the same. So what do capitalization rates mean? Excuse me. For the buyer, a high cap rate means a lower purchase price. For the seller, a low cap rate translates into a higher sale value. It's lower risk for the buyer. For the buyer, a low cap rate means less risk. And for the seller, a high cap rate relates to a more difficult sale. It's higher risk. People aren't so interested in buying properties, businesses that have a high risk. Back to Jeff's question. Well, some people will, Jeff. They want to do it because they've got everything tucked away in safe investments and stuff. They've got their life planned out. They're making lots of money in these investments. They're good for their retirement. Let's take a flyer now on a mechanical shop in the middle of nowhere and see what happens. People do that kind of thing. So this is the basic bottom line on what cap rates mean for values of businesses. Any questions? All right. So I mentioned this one earlier. Tim Hortons cap rate. And I think right now, actually, for a franchise for Tim Hortons, it is around 4%. But just as an example, for 4.5, you have a $2.22 million value, right? 100,000 divided by 4.5. But what's that mom and pop restaurant cap rate? They might be doing $100,000 last year, but next year they might not. Where the Tim Hortons is going to probably do more NOI next year than this year, okay? You can pretty much count on Tim Hortons every year doing $100,000 NOI, as an example, okay? So their cap rate is 4.5. The mom and pop restaurant, can they guarantee, like Tim Hortons can, that they can do $100,000 a year? They may have had a spectacular year last year. But what about this year? What's going to happen this year? Tim Hortons is pretty well known. God, maybe a Tim Hortons will open up beside the mom and pop restaurant and put them into the toilet. And so that's why their cap rate is higher. But guess what? Are you willing to take the chance? It's only worth $1 million. Are you willing to take that chance? It's a measure of risk. I know I'm just drilling this into your guys, but it's really important that you understand this. Do you have any questions? Okay. So the definition of a capitalization rate, it can represent the percentage return may receive on an all cash purchase. $1 million NOI, a $17 million value equals a 5.9% cap rate for an all cash purchase. Therefore, the investor could, or maybe get a 5.9% return on an all cash purchase. This is answering Farsheed's question from the beginning. So 5.9%, that's pretty safe. A lot of people would do that. What's the opportunity cost? The opportunity cost is I could, if I had a $17 million cash, what could I do with that? I could invest that into a GIC, and if you had 17 million today, you're probably getting more than 3%. You might be getting 4 or 4.5%. Let's say it's 4.5% that you can invest this into a GIC at $17 million. Your opportunity cost is 1.4%, the difference between 4.5 and 5.9. And people will very carefully look at that and go, well, I don't know. I think I'm safer at 4.5 than 5.9. And that difference is called the opportunity cost. So a definition of a capitalization rate, what you should get for an all cash purchase. So capitalization rate or return on investment. What happens if the investor is not a cash buyer? How to calculate actual returns. And now we're talking about return on investment. So the capitalization rate is going to give a buyer an idea of the risk involved in purchasing this business, okay? But what happens if they're not a cash buyer? Now you have to figure out your actual return on investment. So an ROI. An ROI can tell an investor the actual percentage return for any specified segment of time. And it's usually 1 year, sort of matching the net operating income statement, okay? The return on investment, the ROI, allows an investor to manipulate the NOI of a company and add expenses, for example, a mortgage payment, okay? A non-cash buyer. ROI will tell an investment the average profit displayed as a percentage over a specified period of time, regardless of how much profit or loss in each year is incurred, okay? That is different from a capitalization rate. So at the beginning, I said I have agents who say they have buyers that want a cap rate of 14%. Okay, well, do they actually want a cap rate or do they want a return on their investment of 14%? And I would say that most want a return on investment of 14%, and they have the two terms muddled up together. They've got it kind of mixed up, okay? Sure, can the capitalization rate be 14%? And sure, can that equal the return on investment? Sure, if you're lucky, okay, because 14% is what? It's a risky investment, okay? 20% risky investment. 9% even today could be a risky investment. What is a safe investment? Well, 4%, you know, your opportunity cost is only 1% between a 4% cap rate or a return on investment and a 3% GIC, okay? So we have to look at both. When you're looking at purchasing, you're going to look at capitalization rates and return on investments. They are two different things. So here's a return. An ROI example. So $1 million investment, $75,000 NOI. The cap rate is 7.5%. That's pretty straightforward. You just have to go back to the mathematics page that we looked at a few slides ago. But now you don't have a cash buyer, okay? And I've just made these numbers up. It's no realistic number here, okay? Assume a yearly mortgage payment of $35,000 and a 5-year term. What is the actual percentage rate of return is the ROI, okay? Because now you have an NOI of $75,000, right? From up here, but now you have to spend $35,000 a year on a mortgage payment. Your return now is $40,000. It's actually only a 4% return, not 7.5% as the capitalization rate. Okay, now I got a little note on here, not exactly because interest expense is not accounted for here. Okay, so there's taxation things that we talked about in the income statement last week, okay, that this could be added in here, but we're not, that's getting too complicated. And once again, I'm not an expert, but here you have it. You thought you were going to get 7.5%, but you're actually only going to get 4% because you now have to spend $35,000. Here's another one. Your purchase price is $1 million. Your year one NOI, so hopefully, is going to be $75,000 based on past history. Year one expenses, you have $35,000 for your mortgage. Your buyer says, oh yeah, but look at this old truck. I'm going to have to buy a new truck. $40,000. Update and paint the offices, $10,000. Total expenses, $85,000. Well, hold it. Your year one NOI is 75,000. You're spending 85,000 to bring the business up to where it should be, kind of thing. Okay. You've got a loss in year one of $10,000. Year two, your NOI has gone up because of the money that you've spent. So now you have 85,000. You still have your mortgage. You're going to have a second truck of $40,000. You found out that you're making more money because of it. So why not? $10,000 profit this time. Yay. Year three, $95,000. You're building your NOI. Congratulations. Your year three expenses, 35,000, but now you've had to hire an extra driver for that second truck. But now your 3-year profit is 40,000. Your total 3-year profit is 40,000. You lost 10,000, you gained 10,000. So that's even, and you've made $40,000. What is the ROI? It's 1.33% per year. I've got $40,000 over 3 years is $13,000 a year, $13,300 a year. So your ROI now is 1.33, where your capitalization rate was 7.5%. So now I'm trying to show you the difference between when people say, I want a cap rate of 7.5%. Well, are you a cash buyer? Well, great. Okay. But what happens if you have a mortgage and you need to be able to explain to your potential buyer, well, but yeah, let's figure out what's your return on investment. Two different concepts. Does anybody have any questions? You know, the last week and this week, you guys let me off easy on the questions, so thank you. But I'm more than willing to answer your questions. Does everybody get this? I hope so. So here's a formula. That's exactly what I just showed you. If you want to take a picture or wait till it's on our YouTube training channel, it is the return on investment formula for you that I just did. So cap rate or ROI, don't get confused. Cap rate is for a cash buyer. Remember, it is a measure of risk based upon past performance. It is not necessarily what's going to happen tomorrow, all right? You might look at the stock market and boy, goodness, the stock market has done very, very, very well over the last, 3-4 years, let's face it. I mean, and, is that going to happen tomorrow? Well, what happened 10 days ago? And I don't mean to drag the war in Ukraine into this, but what happened 10 days ago is all of a sudden the war in Ukraine came along and the stock market went. What happened when COVID hit? The stock market went, right? Places, Restaurant Brands International is a great example. Airlines is another great example. Airlines were flying high just before COVID hit. You want to take a look at a 5-year chart of airlines and stock markets and just see it go like this, and then when COVID hit, unbelievable. And there's that, I'm using that as an example to try to tell you that the mom and pop restaurant that was looking good last year may not look so good this year, where a Tim Hortons will, and they have different cap rates because of risk. ROI is for any adjustments to the NOI going forward. Cap rate is risk based on past performance, okay? A buyer can increase the NOI because of additional sales, which would increase the ROI. Or as stated above, add in expenses, which will lower the ROI. It does not necessarily affect the cap rate. Any questions at all about this?
Thank you so much for watching. If you like our video, please hit the like button, the subscribe, and even the little bell to get notifications, just so you can stay in touch and watch more of these great videos.